All right, everyone, it's the top of the hour. Thank you for joining us on time today. We really appreciate it for our webinar on consumer loan underwriting. And with that, I'm going to turn it over to Flo and Linnell from OISTA to get started.
Hi, this is Emily Trump from OISTA. I'm here with Florence Ledka. If we can just want to give everyone a little overview of what we're going to be doing here today. This is the first of our two-part underwriting session. Today we're going to be talking about consumer lending. We chose consumer lending for the first webinar because it's really in a lot of ways more straightforward. So for those of you who are new to underwriting, we hope this will be an excellent introduction. For those of you who are more experienced, we hope this is just a nice review, and also that you can contribute some of your ideas during our discussion sections. If you are attending and are not interested in consumer underwriting, please know that most of the things we're going to discuss today apply to all types of lending. So we're going to go over the elements of effective loan policies, explain the role of an underwriter, outline the 5 C's of credit, discuss preparing a credit memo, and then talk a little bit about what should be in your loan files. So just to introduce ourselves a little bit, my name is Emily Trump. I'm the Lending and Compliance Manager here at OISTA. Prior to coming to OISTA, I was the loan officer for a small native CDFI serving the Crow Creek Reservation in South Dakota. So I have experience making these small consumer loans, and I'm hoping that all of you can learn from my mistakes and some of my successes as well.
And my name is Florence Ledka, and I'm the Chief Financial Officer at OISTA, and our lending and finance departments are kind of combined, so they both fall under my leadership. And so I'm pretty extensively involved in the lending and do a lot of underwriting myself, as well as review the underwriting that Emily does. So that's why I'm on this webinar training as well.
And we just wanted to start with a quick poll to get a sense of what your experience level with underwriting is, and that could be consumer underwriting, housing underwriting, small business underwriting. Okay, so it looks like most of you have at least a little bit of experience with underwriting. Welcome to our newcomers as well. We hope this is a good introduction and not too overwhelming. Just so you're all aware, we will have office hours tomorrow. If you have questions that we can't address here. Thank you. And then another quick poll, just trying to get a sense of what kind of underwriting does your organization currently do. We've divided this into the 3 major lines. So consumer loans could be anything from a credit repair loan to an auto loan. Some CDFIs do an employee loan program, offering an advance on a paycheck for tribal employees. Or small business loans, that would be inclusive of microenterprise as well. If you're doing loans to artists or agriculture loans, we would classify that under small business. Great, so we've got some great diversity in experience. And just to give you a little sense of this, we're having a small business specific webinar in January. For those of you who underwrite housing loans or are thinking of moving into that area, you'll find a lot of the analysis actually similar to consumer lending. So this is going to be, I think, the more helpful webinar for you, but please, we encourage everyone to attend both.
So I'm going to get started with the 10 elements of a good loan policy. So the very first thing you want to think about when you're developing your loan policies is you want to define the mission of your organization and what your target market is for your lending products. It can be really broad, or it can be pretty basic as well, as long as it's kind of specific, and so that when somebody looks at your loan policy that they know exactly what your mission is and what your target market is behind your lending. And the mission of your organization doesn't necessarily need to be exactly the same for your lending mission. It can certainly be the same, but it doesn't have to be. So you might have a more broader mission for your organization and a more specific mission for the lending part of your organization. Your target market is pretty well defined through your original, mission in for your overall organization. Generally the people that you're serving are going to be the same for your lending products as for any of your development services. It should be board approved, and so your board should review what you're stating here and make sure that they're approving of it. Also in this part, you would probably want to talk a little bit about your guidelines for your lending program or your lending department, and like the policies that surround that and what goes into it. Also another thing, your philosophy of lending, like the general quality of loans and things that you're going to look for on that. And then obviously, with your target market, who are you going to lend to? So the next part of the loan policy would be your lending authority. In this regard, you would want to know or specify how many people does it take to approve a loan in your organization? Is it just with your lending officer? Is it with your underwriters? Does it need executive director approval? Does it need to go straight up to the board? Those are all different things that you can consider. Do you want just one individual to have loan authority? Do you have a loan committee? And is your loan committee going to approve every loan that you do? Or is it going to be by loan type? Are you going to specify different authority by type and by thresholds? For example, like maybe all loans under $5,000 can be approved internally, but any loan over $5,000, has to go before the loan committee. How is the loan committee structured? Is it board members? Is it community members? Is it tribal members? So your loan committee can be made up of various different statutes, and it doesn't necessarily have to be all board members. It can be all board members. It cannot be any board members. So there's a lot of flexibility there, and so it just all depends on what's going to work for your organization and who you're serving. Should there be a threshold for things that go for board approval, like straight to the board? Like once it's made, depending on what your policy reads, once it's approved by your loan officer or your executive director or your loan committee, depending on how that's structured, is there any type of loan or amount that would need to go to the full board approval? That should all be specified under this lending authority. And then another thing that should be specified here is when your internal staff or your loan officer or your underwriter, when do they need to go to higher authority, either the executive director, the board, or the lending committee, for different types of modifications to not only the loan policy itself when you're underwriting, or perhaps a modification to an actual loan after it's already in existence. Number 3, delineate responsibilities for reporting loan information. So in here is where you would specify what reports are you going to prepare for your lending department or your lending activities? Some examples would be like a portfolio report, an aging, a watch list, capitalization, for lending capital. Who are the reports for and who reviews them? Are they for internal purposes only? Are they for your board of directors? Are they for your loan committee? Are they for management? Are they for external funders? So all of that should be, totally specified under number 3. Also, who is responsible for preparing the reports? Is it your loan officer? Is it your underwriter? Is it, an administrative assistant? Is it the executive director? And then the last thing under this one would be, how often are they required? So this is like an internal decision, except for when it comes to funders. You may have some debt capital from a specific funder that wants reporting at a certain interval. And so that would be then really pretty much dictated by your agreement with that particular funder. But as far as like these other things for internal purposes, you're able to like decide that segregation internally on your own. The next part of a loan policy would be describe origination and the underwriting criteria and the whole process that goes in. So some of the things to consider under this one would be, what are the eligibility requirements for each type of loan? For example, are you only lending to tribal members? Are they specific tribal members? Do you have or are they in a specific county or a specific region? Is there a certain percentage of your loan clients that need to be Native American? And if so, what is that percentage? So basically all of that kind of information as far as like the eligibility. Another thing that would be described in this section would be the different types of loans and what they could be used for. For example, if you have agriculture loans, those can only be used, towards agriculture, fishing boats, or agriculture related businesses, ranching, farming, different things like that. And then the other thing to consider would be, is there different underwriting criteria for the different types of loans? So sometimes, depending on your loan types, you might have different underwriting criteria. So agriculture, I'll bring that up again. That agriculture would have a different underwriting criteria than say, a debt consolidation loan or just a real simple consumer loan. I know some of you out there do, like auto loans. So that would have like a different underwriting criteria. Another thing I think that's popular with some of you are like Christmas loans, which are like really low amount, like maybe, $500 to $1,000, with a very short turnaround time. So you don't you pay it back within 1 year. So then your criteria, because those are smaller amounts and because the principal comes back into you on a more regular basis, like a quicker basis, then your underwriting criteria for those types of loans it doesn't really need to be as rigorous. So if that were the case for any of you at your organizations, then you would definitely want that criteria and that process, spelled out in this section. The next section is state documentation needed for a complete credit file. So in here, you would want to specify what filing system you're going to use, what documents you want in there, W-2s, tax returns, check stubs, references, the credit application, all those types of things. Where and how are the files stored? Are you going to have just hard copy files? Are you going to have hard copy files and electronic files? Because of the sensitive information that's contained on like the credit application and your W-2s and stuff, those all have social security numbers and addresses and phone numbers and that kind of thing. So you want to make sure that those are like secure and that they're confidential. So you want to consider all of those things, and you want that to be specifically spelled out in your loan policy. So we're on to number 6, and number 6 talks about collateral guidelines. So some of the things to consider here: do you have consistency in applying collateral and security standards to all of your loans, or does it vary on the type of loan? or the amount perhaps of the loan. What is the minimum or acceptable range of loan to value? And there's some like general principles you can follow, but you can also just set that internally to whatever feels comfortable, based on the needs of your target market. What are your valuation practices? Like, how are you valuating it? Are you, for example, for a car loan, are you going out to, Kelley Blue Book and valuing it that way? Or are you, using different types of resources like that? How are you securing your collateral? Are you filing all of the liens on the collateral? Are you making sure your name is on the title of these vehicles as a secured party? Another thing that can go on, fit into this category is insurance on collateral. Like a lot, for example, on auto loans, you have to make sure that you're the secured party on that insurance policy. So that can all go in here. And are there any exceptions? And if there are, who can approve those exceptions to the collateral guidelines that you've established? That would all go into that section. The next section is set loan rating and the loss reserve system. So how will you risk rate your loans? What is the scoring grid? And you want that all included in the policy in this section. How will you calculate your loan loss reserve? And how often will you allocate loan loss reserve and who will approve it? So those are all things to consider and make sure that's documented in this section. The next section is number 8, and it's outline how interest rates and fees are set. So what are your rates? What are your terms? What are your fees for all of your different loan types? You could perhaps have the same for all of your different types of loans, but most likely that's not the case. Most likely you'll have different repayment plans for longer extended time periods or higher interest rate depending on what the loan is for, and then different fees like an application fee or an origination fee on your loan. So all of those, you would decide on those, what those are going to be, and you would lay them all out in some type of a table or a matrix in this section. And then another part of this one is a review of the fees and rates. So as your lending capital changes, your rates may need to change. So if all of a sudden you're finding yourself paying a higher percentage rate for some of your lending capital, you'll definitely want to adjust your rates so that you're still getting the accurate spread. And the same for fees. You want to regularly review that to make sure that when you're underwriting a loan, and if you have an origination fee or an application fee for that particular type of loan, you want to make sure that whatever that fee is that you're charging, if you are charging, that not only is it reasonable for your target market and it's something accepted by your target market, but you also want to make sure that it makes sense for what your actual costs are. So for when you're underwriting these loans, it would be good to track how much time your staff is taking on underwriting, so you kind of get a feel for what your internal cost is for those things. And then another thing to establish here is your minimum spread. So I kind of touched base on that earlier with, as your lending capital, as those rates change, decrease or increase, you want to make sure you're evaluating that to make sure that the interest rate you're charging to your clients then gives you the spread that is required that you need for that. The next one is set a preferred upper limit for total loans outstanding and concentrations. So in here, in this section, you would want to consider what is your maximum exposure per borrower. So how much, based on a percentage of your lending capital, how much do you want one borrower to be able to have of that? How do you define lending capital? So you'll have some specific grants, perhaps that's specific for lending capital, but you also may have some other types of contributions or perhaps contractual revenue that's specifically for your lending capital, as well as any debt capital that you may or may not acquire. And then other portfolio concentration limits. So there's other concentration limits or exposure limits that you want to consider based on your portfolio, and that would all depend. That's a totally individual per organization. That depends on so many factors, like how much how much of your total debt lending capital that you have available, how much is debt, how much is grants, how much is revolving. And so you would look at all those different things and decide on those concentrations internally. And then again, kind of like some of our other sections, are there any exceptions to these exposure limits or these concentration limits? And if there are exceptions going to be allowed, how do those get approved, or who has the authority to approve them? And then number 10, the last element, and I want to be kind of a little bit clear here, there could be more elements to your loan policy. These are just the 10 ones that are like really like required and like the must-haves in your loan policy. So number 10 is determine how to detect, analyze, and work out problem loans. And so this is one thing that we find a lot that's missing from loan policies, is what your collection process or policy is going to be. And it's really important that that's in there, because a lot of times if it's not included, it just doesn't happen. And then before you know it, you might have a 30% delinquency, rating on your whole portfolio. So it's really important that this number 10 gets included in there. But you want to, in this section, you want to be specific about the time frames for taking action. Like, are you going to do it 15 days past due, 30 days, 60, 90? And there might be a different action plan for each one of those time limits. Like 15 days, you're going to do this. 30 days, you're going to do this. 60 days, this. So you want to be very specific about that and what the specific action item is. You want to record here who is going to be responsible for all of these different action items. At what point do you decide to restructure a loan? At what point will you start foreclosure and what that process is? When are you going to write off delinquent loans, and what is the approval process for this? Does this have to go to the board, the lending committee? Does the ED just have authority to do that? Perhaps in some instances it could be, the lending officer, depending on the size of your organization. And then the last but not least is who has the authority to make any decisions on steps beyond all of this, or anything in that whole process.
All right, so now we're going to move on to loan loss risk, which is the biggest function of underwriting, is evaluating loan loss risk, because as CDFIs, we're in the business of making loans. We're not in the business of making grants. So what we are interested in is what is the probability that our loans are going to get paid back. And some of loan loss risk is inherent to what we're doing. As CDFIs, we're not making the loans that banks are making. If banks, we would not need to exist. So we accept that inherently the loans we make are a little bit riskier. But that can still be broken down by the types of loans that we're making. So traditionally, we think of housing loans as some of the safest loans because they're secured by real property that's worth money. And of course, if a family is making choices about which debts to repay, they're probably going to prioritize first their house, then maybe an auto loan so they can get to work. And then small business loans are generally seen as riskier. Startup loans are especially risky. Also, if you're doing unsecured consumer loans, just acknowledge that that's a little bit riskier line of business, and we accept that as part of our underwriting process. The effectiveness of training programs. So, the reason that CDFIs are able to make successful loans to people and in places that sometimes traditional lenders see as too risky is that we pair our loans with appropriate training programs and support for our borrowers. So for a consumer loan product, you're going to be looking at what's your financial education program look like? Are you doing credit coaching? Are you helping your borrowers with budgeting? What are the supports available for them? The quality of loan policies, we always start with loan policies when we talk about underwriting, because that's the framework that's going to guide your decision making as you're selecting which loans to make and also managing those loans after they've been made. And just a quick reminder, you can have the most beautiful loan policies in the world, but if your staff isn't familiar with them and you're not referring to them on a regular basis, it's very easy for your practices to drift away from your policies. So just always remember to use your loan policies as a guide in your daily work and to review them on a regular basis so that, if they need to be adjusted or changed, that you're doing that in consultation with your staff and your board of directors. And finally, the quality of your staff, your loan committee and your board really help you manage your loan loss risk because, if you have a staff that is familiar with your community, they're going to be able to say, the small business plan is great, but I'm not sure it's going to work here. Or you have a board of directors where someone is really experienced in banking and they can talk about best practices in portfolio management and help you with those pieces. And finally, just I think I've said this earlier, but we know we can't get our loan loss risk to zero because of our mission. We're not making just the surefire slam dunk loans. We're also accepting some risk along the way, but doing the best we can to support our borrowers to make them successful and incorporate what we've learned as we go along in lending to improve our underwriting criteria, to improve our training programs, and always monitor and evaluate our so that is a lot to put on your loan officer. So in order to help them analyze the true risk of loan loss for a particular loan, we establish a loan rating system, which just gives you a systematic way to evaluate risk for each loan. Some of this is subjective. You're making judgments about the character of your borrower or trying to see into the future and say, what are the threats to this loan? With a consumer loan, a lot of this is going to be income-based. What is the threat to this borrower's employment? We're just trying to give you a structure. When we talk about the 5 C's of credit here coming up, those are the elements you're going to be evaluating. Your loan rating system attempts to put a number on those, generate a score so that you can, when you're presenting a loan to your loan committee or to the approving party, that they'll have a summary of the riskiness of the loan, and then you can track that, use that score throughout the process with your borrower to evaluate the riskiness of your overall portfolio.
So we do have a question on here.
Sure.
From Alyssa, she's asking, does anyone have in their collection policies if a loan can be reconsidered for a certain period of time, or if it was a previous collection account?
So I think if this is a previous borrower you've had where the loan with you is now in collections, generally the practice I see is that CDFIs want to have those loans repaid in full before they will consider another loan to the same borrower. If the collection item is to another lender, that's going to really depend on the type of loan that you're making. Often with consumer loans, which we're discussing here today, one of the purposes of the loan is to consolidate existing debt or to help a borrower who's struggled with their credit in the past get back on track. So I don't see in loan policies very many blanket prohibitions about lending to people with items in collection, but that is certainly something you take into account. And we'll discuss that when we get to the 5 C's of credit. And Diana asks if this will be sent out via email. Yes, we will make the slides available afterwards, and I believe also the recording will be available. So when we talk about underwriting, the underwriter has 2 primary roles. First is to assess risk, which just means measuring it, is saying, is this a loan that we want to make, or is the chance of default too high? So that's why we have the standard risk rating system to help us say, is this a loan we want to make? And how can we turn the subjective parts of our analysis into an objective measurement? But then after we make the loan, we're going to try and manage the risk. And that means, as the underwriter, that you're going to be anticipating places where you can help the borrower and reduce the risk of non-payment. So that might be with additional technical assistance, either before the loan is made or after. So an ongoing credit coaching relationship, or helping a borrower get into a matched savings program, and then managing risk through ongoing communication with your borrower, and through your collection policies. The huge advantage that CDFIs have is that we have a personal relationship with our borrowers. So assessing risk doesn't start with when a loan application lands on your desk. It starts with the first contact you have with your potential borrower. So you're going to be using the TA process all along the way. If you have a financial education program, you're looking at how committed is your borrower to either make their appointments, are they participating in class, are there red flags that you see a place where you can help the borrower before they even get to loan closing. And then that ongoing relationship is really why we see CDFIs have such a low rate of loss compared to conventional lenders. It's sort of counterintuitive. We think of ourselves as making the loans that banks don't want to make, and yet if you look at our overall numbers, we're very successful. It's because we have that ongoing relationship with borrowers where they feel both that the loan officer and the TA provider are cheering them on, really are pulling for their success, that the CDFI is a safe place to go if they're struggling with something, but also that because you're running a community loan fund, that their repayments are helping to benefit their neighbors. And that's something we understand as native CDFIs, that we're all in communities together, and so as local organizations, you have an in with your borrowers where they're going to be more motivated to help your CDFI succeed so that you can continue to lend and provide technical assistance. So we just want to pause here and ask for contributions in the chat box. I think we'll see where Alyssa and Diana have already contributed. How do you evaluate risk for your native CDFI? And do you have different systems for different types of loans? Just looking for any stories of personal experience. Colleen uses 4 C's of credit. Excellent. We have 5 C's, and I think you'll see some different ways of expressing the 5 C's of credit floating around through people's loan policies or on the internet. Just know that if you see slight variations in terminology, that's perfectly fine. I'm not asking everyone to go back and change their risk analysis systems to exactly match ours. The 5 or 4 C's of credit have been articulated in different ways, but they're all getting at the same underlying ideas. So it looks like people have a risk rating matrix or a risk rating worksheet. That's really helpful to your underwriters, giving them an objective way to evaluate things and make sure they're considering each of your risk factors. So some of you look at credit score or debt to income ratio, employment history, length of employment. We probably touch on this a little bit later, but credit score is often a metric where, especially with consumer loans, you may not be weighting that very heavily, or you may be looking at non-traditional forms of credit, because a lot of our consumer loans are geared towards helping people fix their credit and access traditional banking services. So a poor FICO score is not always an indicator that you don't want to make.
So thank you everybody for participating in that little activity. So we're going to move on and talk about the 5 C's of credit. So the 5 C's of credit are character, capacity, capital, conditions, and collateral. And together, all of these serve as a way for lenders or CDFIs to evaluate the creditworthiness of any of your potential borrowers. Some organizations use a more simplified model for assessing risk in their consumer loans. It's called the SAW model. And so what they're looking for here is stability, ability, and the willingness to pay of your particular client. Lenders generally look at your ability to repay, your level of debt that you already have, and how you plan to use the funds, and what collateral that you may have that you can offer. Most lenders incorporate the 5 C's of credit to understand how likely their client is to repay their debt. Character is reflected in credit score. Capacity measures their ability to repay. Their capital looks at their total debt. Conditions include how the funds will be used. And the collateral is what assets of their own that they already own that they're pledging toward this new debt that they're trying to take on. So capacity is basically their cash flow, their income. What is their income that they have coming in, and how can they afford to repay the loan that they're trying to request? You want to make sure that they obviously have enough to pay back. One thing to consider here is seasonal employment is kind of like a big deal depending on the area of the country that your org is located in. So, if you're located in the Midwest and you have a winter season and you have a construction worker that comes in to apply for a loan, that person may or may not get laid off during the winter months, and so that their income goes down. So that's like one thing that you definitely want to consider. And one of the things you can kind of do to get around this is you can kind of structure the loan repayment terms to match the employment. So you could kind of restructure your conditions and your terms. If that person does get laid off, you would maybe only collect interest during the winter months and collect principal during the summer months when the person is working full time, and different things like that. Another category that falls into this is like teachers. You know, teachers sometimes they elect to get paid over 12 months, but some of them elect to get paid only during the school year, and then they pick up like a second job or a part-time, you know, like waitressing job or something like that during the summer. So that's like other things that you can consider. Other source of income, child support or alimony payments, and then the reliability on those. So you would want to make sure you got some sort of history that they were getting, even though if they're supposed to get $50 a week in child support, are they really getting $50 a week in child support? So you want to definitely make sure you're looking at the history in that. Disability payments, are the disability payments temporary, or are they on permanent disability? Retirement payments, work comp benefits, public assistance, part-time, per capita. And a lot of times, Native CDFIs especially are able to work out arrangements with their tribal organizations. If there is per capita available, they are able to, you know, garnish that or collect that when those per capita payments are made to the individual tribal members. So that's kind of another way to, not only is it, you know, helping in your analyzation of the capacity, the ability to repay, that can also be used like in your risk rating too. Like if it is solely on per capita, you know, that's pretty much guaranteed. So your risk rating, even though they might have a poor credit score, that payment is pretty much guaranteed to you, so you can have your risk rating be lower. It also could be used as a form of collateral as well. The next section here is debt to income. So this is this measurement evaluates the percentage of a client's monthly debt obligations and what their gross monthly income is. So kind of like cash flow. So what do they have coming in and what do they have going out? You take out your total debt payments and you divide that by your gross income and you come up with a percentage. So you can do that, you know, for a specific time period, for monthly, quarterly, yearly. You also want to make sure that you're including rent payments in there and creating, you know, and when you're comparing these and evaluating those, you want an equal comparison between, you know, people who have mortgages versus rent. The next thing is character, factors to consider, credit report. So what is their credit score? Any non-traditional credit history they may have, any trainings or financial education that they've received through your organization or perhaps other ones in your local area, their work history, different things like that. So you want to make sure that the application matches the information you're able to verify. So like employment, debt payments, contact information. And you want to make sure that if there is a credit problem with them, that they're able to resolve it. So, you know, it's fairly common for past debt to go to collection without the borrower to be aware of it. So when you pull their credit report, if you see some collections on there, they may have like no idea. So just offering them some sort of way to assist with them and help them, you know, repair that or get rid of that. Another thing is, you know, the training. You can actually require training. You can actually require part of your, you know, any of your financial education classes to be a requirement of getting a loan from you. So that's all things that you can do to when you're evaluating the character. Payment history. So do you want to look, does the client have any late payments? And if so, what were the reasons for that? Because there could be like a really good reason for it. They could have, you know, been in an auto accident. They could have been laid off for a certain period of time. They could have, you know, gotten sick. Is there a pattern of late payments? Or were they just isolated incidents? How delinquent are the payments? Are they 30, 60, 90 days? And do they have a, you know, reasonable explanation for them? When were the late payments? Are they recent, within the last 12 months, 24 months? Are they, you know, older than 2 years ago? You know, maybe they just had like a rough time during a certain time period. And it could be anything. It could be like the birth of a child, a death in the family, divorce. So there's many reasons that all those things, change, and they could have like really good, explanations for why that happened. Another thing you want to look for is major derogatory credit, bankruptcies, judgments, liens, garnishments, any federal debt, collections, anything that's gone to collections, foreclosures. And then, depending on these derogatory credit, if any, do they all count equally, or are some more for your organization? Are you going to consider some worse than others? Just all kinds of things to consider when you're evaluating this. Non-traditional credit, so like rent payments, a lot of may or may not be on their credit report. If a rental, if a housing organization is collecting rent, utility payments, insurance premiums, bank account history. So you may have a client come in that doesn't really have much of a credit score, and it's just simply because they've never acquired credit before. So you can look at the non-traditional credit as a way of, evaluating their credit worthiness, and kind of give them their own credit score based on how they're paying, for some of their other living obligations.
All right, so I think I kind of spoiled the answer I was looking for on this one, but I touched on sometimes with consumer loans, not looking at a credit score as the be-all, end-all of credit analysis. So I just wanted to get some of all our participants' thoughts on how consumer lenders should look at credit scores, and how that might differ from mortgage and business lenders. And I know we have a lot of diversity of experience and lending types here, so love hearing from everyone, even those of you who are not currently doing consumer. Okay, Alyssa says, you can look at, if you have the ability to look at other factors, that's one of our advantages as small local organizations, is that we can look at loans in a holistic way, and also looking at how we can help our borrowers improve rather than giving a firm no on the loan decision right away. Janelle mentioned something I've had a lot of experience in. A lot of clients who have medical bills in collections, because IHS didn't pay in a timely way. So that's often a derogatory mark that you would exclude when evaluating the credit of an applicant. Okay, we're having some great conversation, and I encourage you to continue making contributions, but we're going to move this along so we can cover all parts of our presentation.
So we're going to move on to evaluating the value of the collateral. So lenders don't always have to take collateral into consideration, but when they do, they definitely want to consider that when they're evaluating the loan in general. Is it going to be secured or unsecured? Loans that are secured by collateral are typically considered less risky than unsecured loans. Sometimes those less risky loans then will have better terms, and sometimes you'll be better, more easily qualified. You'll be, your clients will be easily qualified if they do in fact have collateral. So the 3 steps in evaluating the collateral is, number 1 is you're going to identify the available collateral if there is any. You're going to determine the market value. And then you're going to discount that market value, because as you know, even though something might have, a value of $10,000, the only way it's really worth $10,000 is if somebody is willing to pay $10,000 for it. So you definitely want to make sure you consider all of that when you're evaluating it. Another thing to keep in mind is intangible assets, such as patents or trademarks. Some of your business clients might have some of these, especially contracts, with some of your business clients. They might need like an operational loan or a capital loan or a working capital loan because they just signed a $500,000 contract that they've got to amp up their staff or buy an extra truck or buy some equipment in order to meet that contract. So those are other things that you can consider. So collateral evaluation. So this is like a little chart, and it's kind of showing you how different, how you can evaluate it differently based on what type of thing it is. So there's kind of some standard guidelines you can use for evaluating, but I always keep in mind that most borrowers won't have much in a way of collateral, and if they do, it might already be secured by another lender. Like if they have a car, they might it might be worth 10,000 and maybe they only owe 8,000, but that $8,000 is still secured with another lender, so they really only have like $2,000 of equity in that car. The same like with business assets or housing or things like that. Banks can easily use like savings accounts or CDs as collateral, but CDFIs in general aren't going to take those types of, they'll consider it in their credit evaluation, but they're generally not going to take those items as collateral. So collateral, mitigating your risk with collateral. I always, so if they're getting a loan for $10,000, I always try to secure it with more than $10,000 in collateral. Make sure that it's valuable to the borrower. So if they bring in a car as collateral, like the title to a car that's sitting in their barn that they never use, if you were to repossess that, if the loan were to go bad, that might not be any value to them. So because it's just sitting there and they're not using it, it might not mean anything to them. So they're going to be more likely like to default on that because they don't really care about that particular collateral. Require insurance and make sure you're checking on that insurance. Reduce loan amount. So if they're asking for $10,000 and maybe based on the 5 C's in your evaluation of their credit, then you decide, well, we want to give them a loan, but maybe they only should have $7,500 instead of the $10,000 or half of the $10,000 or different things like that. I always, make sure that the 5 C's are strong, of course. Hold titles and file the liens immediately. So like actually hold the titles to these collateral items in your office in the loan file. And then you definitely want to verify at a minimum annually. I like to recommend a little bit more frequently here because things change, especially like with insurances and different things like that. So I always like to recommend like 6 months, but at least at a very minimum annually. Capital. So factors to consider, of course, is down payment and any cash savings that they might have. Ways that you can help them is like kind of a match savings program, like the IDA programs that Native CDFIs used to do a few years back. Those were really good. Any kind of budget assistance that you can offer them. So here, one of the things you really want to consider is what the level of leverage is. So debt versus equity. So what is their leveraged amount? In business underwriting, we look at capital very carefully. Like what is the personal investment that the borrower has made in the business, if any? You would want to have it risk at least something personally or like a significant amount of time invested or effort or sweat equity in order to make that worthwhile. With consumer loans, our expectations are kind of lower, but it's still important to see that personal commitment. Down payments might be appropriate when purchasing a car or making home improvements. For credit report loans, savings, and then if the borrowers had enough cushion that any unexpected expense won't cause them to miss a payment or have to use predatory lenders or payday lenders. And then just to touch base on the debt to net worth or debt to equity, it's a ratio that we use to measure capital for both individuals and businesses. So you can measure an individual's leverage amount as well, even though a lot of us just like think of this as a business item, but you can actually calculate it individually as well. And it shows just basically how financially stable that individual or business is. And the easy calculation for it is you just divide your total debts by your net worth. And the lower the ratio suggests that the minimal debts you have. And it appears they should have, that lower the ratio should appear as a less risky borrower to you. Some other ways lenders might look at capital is loan to value. So a comparison of the loan amount to the appraised value of the asset being purchased, like a home or the car. And then the down payment percentage. So the amount of money as a down payment can be calculated as a percentage if you divide the total loan amount by that down payment. So typically, like a lot of mortgages, at least conventional mortgages, like require like a 20% down. Some car loans require 20% down. But it kind of goes back to your original loan policy, what the terms are, what the eligibility is. Is that required? Is it not? Sometimes, you wouldn't have any of that. Conditions, factors to consider. So what are they using the funds for? Other economic factors, like what is the economic climate in your area right now? Are there a lot of jobs? Are a lot of people getting laid off? The interest rate, the size of loans, ways that your CDFI can help. You can help like make direct payments to the vendors and creditors, especially if it's like a debt consolidation or a credit repair. You, instead of giving the money to your client, you can make it to their particular vendors that they owe money to. You structure their loan. We talked about this earlier. Structure their loan to meet their cash flow. Make payments easy through ACH or payroll deductions, including per capita.
And here we'll just jump in with some of the biggest lending mistakes that I've made or seen other folks make. The biggest one is cash flow. With business loans, sometimes we're tempted to overestimate how much the business is going to earn because we want to believe in the best case scenario. On the consumer side, what I see most often is underestimating a borrower's financial obligations. So you've forgotten about a debt payment that they didn't mention, that they had a personal loan that doesn't show up in their credit report, or they have they need to be saving throughout the year to travel to a powwow that's very important to them, something like that. Pay special attention to both income and expenses. Looking at risks that are too subjective and not managing to find some way to evaluate that. I often see that on the character side. You might have a applicant who's kind of flaky, who doesn't make your appointments or is evasive when you're asking them questions. Even though that's subjective, you want to make sure that somewhere in your loan underwriting process, you have a way to evaluate that. Absence of ongoing loan monitoring. So this is really challenging because we're all so busy all the time, right? And so often all the energy goes to making new loans, but not following up on, as Flo mentioned, with collateral, making sure to check in on that on a regular basis, making sure that you're receiving your payments on time and following up with people who are late. And then finally, if you're not pricing your loans correctly, that's the risk that really ends up hitting your bottom line. Because if you're making really risky loans, you're going to have some losses along the way. And your earnings, whether that's through the fees and interest that you charge, or maybe a contract payment you're receiving for providing technical assistance, somewhere along the line, you need to make sure that your loans are paying for themselves, because we have a mixed model. We can't rely on grant funding for all of our support. We need to be at least partially self-sufficient. So just keep that in mind for the Credit memo should just document all the things that are in your loan policy and should summarize all the information that your approving authorities, whether that's the executive director or the loan committee, needs to make decisions, documenting any policy exceptions and loan covenants. For consumer loans, we expect a credit memo to be quite brief compared to small business loans with small dollar amounts. You don't want to waste your time writing up 14 pages on a consumer loan. So here I've just given you a sample of the credit memo I used to use as a loan officer or a consumer lender. Just, does the borrower meet basic qualifications? Do we know how they're going to be using the loan proceeds? What is the collateral? How have we valued that? Have we verified that it meets our requirements? Have we received the title? Are all the pieces of the application in place? And then are there any other things that the approving authority needs to know in deciding whether to approve or not? And this is another thing that we can make available to you after the presentation. Loan closing, just quickly go through this. You want to schedule time for this with your borrower. Make sure that they have copies of all the documents that they need. Give them a chance to review them prior to signing and answer any of their questions. Loan closing is a really great opportunity for you to do more, improve that borrower relationship that is really key. So helping them understand what their obligations are under the loan, that you're, as a CDFI, you're here to help. What should they do if they run into trouble? What is the ongoing TA that's available to them? What's required from them? And so, just as you've been providing TA throughout the loan application process, you want to continue that relationship with loan closing. And then it's very tempting at the end of the process to say, oh, we signed the loan documents, we're done. If you have any collateral, you want to be very timely in the way you file that. Make sure your name is on any title documents that you filed, liens correctly. It always seems that it's the loans that go bad that have problems with collateral. So just to make sure you're following a checklist and doing everything. And then as you complete your loan file, you want to make sure that if you're using a portfolio management system like Down Home or T, that all that information is getting entered, following up on any post-closing things that you need like insurance or titles, filing documents. Most CDFIs I know have a mixed system. They're using both physical files and some electronic documents. So all of those want to be placed in a safe, secure place using an organizational system that if your loan officer wins the lottery tomorrow and calls in rich, that someone else in the organization will be able to figure out their filing system and continue to collect on your loans. And then just here's a quick checklist for you of what's typically in a credit file: the application, any data collection that you've done, borrower's financial documents, demonstration of their eligibility. If you've pulled their credit or released their information somewhere, want to have on file that they authorized you to do that. The credit memo itself showing that it's been signed by the appropriate authorities, any collateral documents, and then of course the loan documents, the promissory note, and loan agreement themselves. So we kind of rushed a little bit towards the end there, but we have a full hour dedicated for office hours tomorrow. If you have questions and want to follow up on any of these pieces, or of course, you can give us at Awista a call anytime with questions on underwriting. We will be sending a registration reminder to everyone. And we hope this has been a really helpful session for you, and that you'll join us tomorrow and in January for our small business underwriting session. Oh, and please fill out the post-event survey. Ben has posted a link in the group chat here. We really appreciate your feedback. It helps us improve future trainings.